There's a shortage, but the price won't rise. Physical silver is vanishing from vaults across 3 continents, yet the market refuses to bid. Retail investors are buying at record levels. Industrial demand has never been higher. Mints are rationing coins. Dealers are sold out. And yet, the spot price sits frozen, disconnected, almost defiant. This isn't just unusual. This is a market in structural collapse. Welcome to the silver paradox of 2025, where scarcity meets manipulation, and the numbers tell a story Wall Street doesn't want you to hear. Let me show you something that should terrify anyone holding paper assets. In January 2025, physical silver premiums hit levels not seen since the chaos of 2020. Dealers in the United States reported premiums of $12 to $15 above spot for American Silver Eagles. In Europe, premiums reached 8 to 10 euros. In Asia, waiting times stretched to 6 weeks. The US Mint suspended production twice in 3 months. The Perth Mint in Australia announced allocation limits, and the Royal Canadian Mint delayed shipments indefinitely. This isn't a supply hiccup, this is a supply crisis. But here's the disturbing part. The paper price barely moved. The futures market, the derivatives, the ETFs, all of them traded as if nothing was wrong, as if the physical world didn't exist. So what's happening? How can a market be sold out and show no bid? How can scarcity fail to produce price discovery? The answer lies in the architecture of modern commodities markets, and once you understand it, you'll never look at silver the same way again. Let's start with the fundamentals. Silver demand in 2024 reached a record high of 1.2 billion ounces. That number comes from the Silver Institute, an organization that tracks global supply and demand with surgical precision. Industrial demand alone consumed over 600 million ounces. Solar panels, electronics, medical equipment, batteries. The green energy transition isn't just using silver, it's devouring it. Then there's investment demand. Retail buyers purchased nearly 300 million ounces in physical bars and coins. Add jewelry, silverware, and other fabrication, and you're looking at total demand that outstrips mine supply by over 200 million ounces. That deficit has to come from somewhere. It comes from above-ground stocks, vaults, reserves, inventories that have been built over decades. And those inventories are shrinking fast. But then the data took a darker turn. In December 2024, COMEX registered silver inventories. That's the silver available for immediate delivery, dropped below 90 million ounces. That's the lowest level in over 3 years. Eligible stocks, silver held in warehouses but not necessarily available for delivery, also declined sharply. Meanwhile, the London Bullion Market Association reported that allocated silver holdings fell by 18% year over year. Allocated means someone owns that specific metal. It's not a claim, it's real, and it's disappearing. Banks aren't talking about it, analysts aren't screaming about it, but the vaults are emptying. Now here's where it gets shocking. While physical silver vanishes, the paper market exploded in the opposite direction. Daily trading volume on COMEX silver futures regularly exceeds 500 million ounces. That's half of global annual production traded in a single day. Not transferred, not delivered, just traded. These are contracts, promises, bets on price movements that will never result in physical metal changing hands. 98% of futures contracts are settled in cash, not metal. This creates a massive disconnect. The price of silver isn't determined by people who want silver. It's determined by people who want to speculate on silver. And those speculators have access to leverage that physical buyers do not. Behind closed doors, something else was happening. In the first 3 weeks of January 2025, bullion banks increased their net short positions in silver by over 70,000 contracts. Each contract represents 5,000 ounces. Do the math. That's 350 million ounces of paper silver sold into the market, depressing the price, while physical silver was flying off shelves. Who were these sellers? JP Morgan? HSBC? Scotiabank? The same institutions that act as custodians for the largest silver ETFs. The same banks that manage metal for central banks and sovereign wealth funds. The same players who were fined hundreds of millions of dollars in the past decade for spoofing and manipulating precious metals markets. Coincidence or business model? Let's pause for a moment and ask the question everyone's thinking. Why would banks sell paper silver when physical silver is scarce? The answer is control. The paper market allows these institutions to manage price without needing metal. They can create synthetic supply through derivatives. They can suppress volatility. They can prevent price spikes that would expose the true scarcity of the physical market. And most importantly, they can protect the dollar. Because silver isn't just a commodity, it's money. It's been money for 5,000 years. And when silver rises violently, it signals distrust in fiat currency. That's a signal central banks and their partners cannot afford right now. Think about the global economic backdrop. Inflation is still elevated. Real interest rates remain negative in many major economies. Government debt levels are at peacetime records. The dollar's share of global reserves continues to decline slowly but steadily. And geopolitical tensions are fracturing the Western financial order. Russia and China are stockpiling gold. BRICS nations are exploring alternatives to the dollar for trade settlement. In this environment, a surge in precious metals prices would send a clear message. The confidence in fiat money is cracking. So the price must be managed, contained, controlled, even if it means the paper market diverges entirely from the physical reality. Now let's examine the historical parallels, because this isn't the first time silver has experienced a disconnect between paper and physical. In fact, it's happened before with catastrophic results for those on the wrong side of the trade. Go back to 1980. The Hunt brothers, two Texas oil billionaires, attempted to corner the silver market. They bought physical silver in futures contracts, driving the price from $6 an ounce to over $50 in a matter of months. But the exchanges changed the rules. They raised margin requirements. They restricted long positions. They allowed only liquidation. The price collapsed. The Hunts were ruined. The lesson Wall Street learned wasn't don't manipulate markets. It was control the infrastructure. Fast forward to 2011. Silver hit $49 an ounce in April. Physical demand was soaring. The U.S. Mint sold over 40 million Silver Eagles that year. Premiums were high. Delivery delays were common. But then, within weeks, the price crashed back to $30. No fundamental change, no demand collapse, just a coordinated sell-off in the futures market led by the same bullion banks that dominate today. Later investigations revealed that traders at these banks were using spoofing tactics, placing large sell orders they had no intention of executing, just to scare other traders and drive the price down. They were caught. They were fined. But the behavior never stopped. And here's the kicker. In 2020, during the pandemic chaos, silver experienced another physical shortage. Mints couldn't keep up. Premiums exploded. Retail investors piled in. But the price topped out at just under $30, far below its 2011 high, and far below what scarcity should have dictated. Why? Because the paper market once again flooded the zone with supply that didn't exist. And once again, the banks walked away with record trading profits while physical buyers paid premiums and waited months for delivery. So what's different this time? The scale. The deficits are larger. The inventories are lower. The industrial demand is structural, not cyclical. Solar panel installations are mandated by government policy in dozens of countries. Electric vehicle production is ramping up globally. Medical technology relies on silver's antimicrobial properties more than ever. This demand isn't going away, and mine supply isn't keeping up. In fact, primary silver mine production, silver mined specifically for silver, has been flat for years. Most silver comes as a byproduct of copper, lead, and zinc mining. If those metals slow down, silver supply tightens further. But what does this really mean for investors? It means you're witnessing the late stages of a market structure that cannot hold. The disconnect between paper and physical can stretch, but it cannot stretch forever. Eventually, one of three things happens. First, the paper price rises to meet physical reality. Second, the physical market abandons the paper price entirely and begins trading at a separate, higher price. Or third, the system breaks. Contracts fail, deliveries default, and trust evaporates. History suggests the third option is the most likely and the most destructive. Let's talk about the mechanics of how this break could occur. Imagine a scenario where industrial users, the companies that need silver for production, start demanding physical delivery instead of rolling futures contracts. Imagine sovereign wealth funds or central banks decide to take delivery on their ETF holdings. Imagine a large institutional buyer, someone who actually wants metal, steps into the COMEX and says, I'll take delivery on 10,000 contracts. That's 50 million ounces. If the vaults don't have it, the exchange has two choices: default on the contract, or allow cash settlement at a price far above market to source the metal elsewhere. Either outcome destroys confidence, and once confidence is gone, the stampede begins. There are whispers, unconfirmed but persistent, that exactly this kind of tension is building. In late 2024, a major Asian sovereign fund reportedly requested delivery on a significant ETF position. The request was delayed, then restructured, then quietly settled in a way that didn't require immediate metal. The fund didn't go public, they didn't sue, but they also didn't get their silver. Not right away, not easily, and that silence speaks volumes. Now let's examine the role of silver ETFs in this unfolding drama, because they're central to understanding the illusion of supply. The largest silver ETF, iShares Silver Trust, holds over 500 million ounces. That's a staggering amount of metal. But here's the fine print. The custodian of that silver is JP Morgan, the same bank that holds massive short positions in silver futures, the same bank that profits when the price falls, the same bank with a documented history of market manipulation. Do you see the conflict? The custodian controls the metal that backs the ETF shares, but that custodian is also betting against the price of silver in the derivatives market. If physical demand surges and people start redeeming ETF shares for actual metal, the custodian has to deliver. But if the custodian doesn't have enough metal, or if delivering that metal would cause their short positions to blow up, what do you think happens? Redemptions get delayed, terms get changed, liquidity disappears. This is not conspiracy theory. This is contract law and market structure. Read the prospectuses. They're filled with clauses that allow the fund to suspend redemptions, settle in cash, or alter terms during periods of market stress. Translation: when you need the metal most, you're least likely to get it. And here's where the tension becomes unbearable. Retail investors, the millions of people buying coins and bars, don't care about futures contracts. They don't care about ETFs. They want metal in hand. They're willing to pay premiums. They're willing to wait. But their buying is dismissed by the financial media as speculative froth or retail mania. Meanwhile, the paper market, dominated by banks and hedge funds, is treated as the legitimate price discovery mechanism. This is backwards. The people buying physical silver are the only ones engaging in true price discovery. They're paying what the market actually demands. The futures market is just a casino with leverage. Could this trigger the next global reset? That's not hyperbole. That's a serious question central banks are quietly asking themselves. Because silver isn't just an industrial metal or an investment asset. It's tied to the broader precious metals complex, which includes gold. And gold is the ultimate monetary metal. If silver breaks, if the manipulation becomes undeniable, if the two-tier market becomes explicit, it raises questions about gold. And if gold's price is also being suppressed through similar mechanisms, then the entire foundation of fiat currency confidence starts to crack. Central banks hold gold as a reserve asset. They report it on their balance sheets. If the price of gold is artificial, then so is the value of those reserves. That's not a market issue. That's an existential crisis for the monetary system. Let me give you a number that should make you think. The total value of all the silver ever mined and still in existence above ground is roughly $1 trillion at current prices. That sounds like a lot. But compare it to global financial assets. Stocks, bonds, real estate, derivatives, we're talking hundreds of trillions. Now imagine just 1% of that capital decides it wants to own physical silver as a hedge, as insurance, as a bet against the system. 1%. That would represent trillions of dollars chasing a market worth $1 trillion. The price wouldn't just rise, it would explode. And the system knows this, which is why the system will do everything in its power to prevent that flow. But the flow is already starting. You can see it in the premiums. You can see it in the sold-out inventory. You can see it in the conspiracy of silence from mainstream financial media. When was the last time CNBC ran a segment on the silver shortage? When did Bloomberg dedicate airtime to comics inventory drawdowns? They don't, because acknowledging the problem accelerates the problem. The moment the general public understands that physical silver is scarce while the paper price is fake, the rush begins. And there's no stopping it. So what happens next? That depends on who blinks first. If the bullion banks maintain their short positions and continue to suppress the paper price, the physical market will diverge further. Premiums will widen, shortages will intensify, two-tier pricing will become obvious. At some point, major institutional buyers or sovereign entities will refuse to accept the paper price and demand physical settlement. That's when the system fractures. Alternatively, if the banks reduce their short positions and allow the price to rise, they risk triggering a momentum-driven rally that brings in speculators, algorithms, and a new wave of retail buying. That rally could push silver past its all-time high of $50 and beyond, especially if industrial demand continues to surge. Either way, the current equilibrium is unstable. It cannot last. There's also a third scenario, darker and more cynical. The authorities step in. Exchanges change the rules again, just like in 1980. Margin requirements spike. Position limits are imposed. Trading is restricted. The narrative becomes, we had to stabilize the market to protect investors. But what they're really protecting is the banks. The ones who took the short positions, the ones who would be destroyed by a genuine price discovery process. This scenario has happened before in commodities markets. It could happen again. And if it does, it will confirm everything the skeptics have been saying for decades. The market isn't free, it's managed. And it's managed for the benefit of those who manage it. What should you do? That's not for me to say. I'm not a financial advisor, but I'll tell you what informed investors are doing. They're buying physical metal. They're storing it outside the banking system. They're treating silver not as a trade, but as insurance. They understand that in a world of infinite fiat currency creation, scarce tangible assets have intrinsic value. They're not trying to time the market. They're trying to survive the reset. And they know that when the disconnect between paper and physical finally resolves, it won't be gentle. It will be violent. And it will be fast. The silver market today is a metaphor for the entire financial system. A facade of liquidity. An illusion of price discovery. a structure built on leverage, derivatives, and trust that is quietly eroding. The physical shortage is real. The data is undeniable. But the system is designed to ignore reality as long as possible until it can't. This isn't just a market correction. This is a warning. The question is, who's paying attention? Because when the music stops, when the contracts fail, when the vaults are empty and the papers exposed as worthless, the people holding real metal will be the only ones still standing. History doesn't repeat, but it rhymes. And right now, it's rhyming with 1980, with 2011, with every moment when the gap between perception and reality became too wide to ignore. The silver market is sold out. But there's no bid. That sentence shouldn't make sense, but it does. Because we live in a world where markets are no longer about supply and demand. They're about control. And control is slipping. The all-time high has been confirmed, not in price, but in absurdity. The disconnect has never been wider. The tension has never been greater. And the resolution, when it comes, will rewrite the rules. If this information changes how you see the markets, hit that subscribe button. Because the story is just beginning. And you're going to want to be here when the system finally breaks. Claude is AI and can make mistakes. Please double-check responses.